And welcome back to the Halftime Report. I'm Bob Pisani. Time for ETF Edge, the market rotation pushing wide swaths of the ETF universe to new highs all at the same time. It doesn't happen very often. At Friday's close, the equal weight S&P 500 was at a new high, along with the market cap weighted S&P 500. Value hit a new high, along with growth. And the defensive consumer staples and healthcare ETFs, well, they were at new highs, too, along with the more cyclical technology and communication services ETFs. It seems like every time one sector falters, another takes its place. How long can that perfect rotation continue going, as we call it? Tom Lydon of ETFtrends.com, Dan Draper, global head of ETFs at Invesco, join me now. And Dan, you don't see value and growth hitting new highs at the same time together. What is it telling you?
I think breadth in the market. Think about a year ago. We were really struggling, worried about geopolitical events. The market was selling off. Now, a year later, we've seen the reversal in monetary policy taking effect. You're starting to see the mega caps now feeding into, as you mentioned, equal weight, into mid caps. And
Tom, this perfect rotation. So you see, cyclicals were strong earlier in the month. Last week, cyclicals were a little weaker, and defensive names like healthcare and utilities were up. It doesn't get any better than that. But how can that continue?
Well, it is a Goldilocks rally for sure, Bob. But one of those things, when you look at value compared to growth, growth has just kicked some major butt out there in the last 10 years. Value, all of a sudden, we're starting to see some money flowing in, and also in certain factors, in fundamental factors, quality factors, value-oriented stocks are starting to get, in this late cycle, a little bit more attention.
Does value versus growth really mean that much anymore? I mean, Dan, Apple's a value stock now. I mean, that's kind of crazy. That's kind of counterintuitive to what you think of. Apple was traditionally a growth stock. Now it isn't, a little cheaper in the market. Does it mean a lot anymore when value is banks and Walmart and Apple, essentially, versus your old Amazon and Microsoft and growth names?
Well, I think it depends on what you mean by value. There are many definitions now through this fragmentation about what value is. But what I do think, you mentioned banks and financials, a big component of value, the yield curve. Now, all of a sudden, we went down below 1.5% 10-year Treasury, now back up to 1.8, approaching 2%. That's a better environment. So you're getting now some macro factors and, as Tom mentioned, fundamentals, in energy, financial, some of these crucial sectors where value can rebound.
And, Tom, you like to point out 300 of the 500 S&P stocks account for only 18% of the weighting. There's a lot of smaller stocks in the S&P 500, and yet that equal weight is at a new high as well. Even the smaller stocks are doing better.
It is, and long-term, RSP, the ETF, which is equal weight, has outperformed the S&P 500 for the last 16 years. It's amazing, Bob. 18% of the S&P 500 is in the FANG stocks and Berkshire Hathaway. I think going forward, especially as we're late cycle, do investors who own the S&P 500 feel like they're going to invest with confidence in that way?
That's a great argument for that classic rotation you're talking about. Thanks.